Welcome to the daily update, where I'll go over the action in the market from Monday, November 11th, and we'll see how things look for Tuesday, November 12th. Had a slight update. We were above average with volume, which was kind of surprising. We pretty much set the high right at the open for the day and then drifted lower, and we were goes in the books as a positive day, but we were just up 0.1%. The bond market was closed in observance of Veterans Day. But the market is still holding up for right now. We'll have to see if that can continue. Sentiment is continuing to tick up higher. If we get up to that 75 level, that's when we'll get more concerned. Right now, we're watching to see, is FOMO going to carry through? The fear of missing out. You have people just throwing money into the market. They like how the election turned out. They're more positive about the economy. And the stock market's really been shooting up in response to this. And so you've got people just throwing money into the market. You've got Bitcoin breaking out to the upside after really bouncing around for quite a while. So things are looking pretty positive right now. That's when we get concerned. Doesn't mean we just switch over and look negative. It's just, okay, let's look for some negative things that we should be aware of here. And there's not very many right now. There's a couple that I'll go through and talk about, but we're looking pretty positive across the board. Now, when all the players come back in Tuesday session, we'll see if anything changes or if we're going to see a continuation. Please feel free to check out the SPX Investing Program. It's up, it's going. There's a link that'll take you to the website and to a video that talks about that. You can email me with questions. One of the benefits is that you get access to the videos as soon as they are prepared. And the daily video is where I really do most of my analysis. All the other videos, even though a lot of people really like those, and that's great. If you want to find out how things are happening and changing on an incremental basis, and that's really what technical analysis is supposed to do. Check out the daily videos and see if they'll fit into the kind of investment or trading that you do in the market. Okay, so we had a higher open. We opened at R1. We're over that 6,000 level with prices chopping along R1. So we didn't really see a lot of buying after that. We didn't see an awful lot of selling, but we started to drift as the day went on. We got back down to the unchanged level, actually turned negative there for a little while. Got down to the daily pivot at 59.95. We chopped sideways to close slightly positive on the day. We were up 0.1% on above average volume. That was kind of surprising. We are still positive in the short, intermediate, and long term, possibly looking overextended in the short term, possibly still showing good momentum. And the market really likes that inflation seems to be under control. The bond market was closed, so interest rates really didn't change. I was keeping an eye on the futures. They still trade, just like over the weekend. And when the stock market is closed for a holiday, the futures still keep trading. They're not very liquid and there's not a lot of change quite often, but it's a good idea just to keep an eye on those. Geopolitical events, we're actually seeing oil going down a little bit now, and we'll see if this has the ability to calm things between Russia, Ukraine, between Iran and Israel. We'll see if other things that are potential hot pockets of geopolitical activity, if that's going to de-escalate, if there's going to be an escalation before we see a change in the administration in the US. A lot of variables out there right now, but for the time being, things seem to be a little bit more under control. And there's really been no fallout yet on either side about the election in the US. Now, that could always change too, and that could have an impact on the market. But for right now, it seems rather subdued compared to what could have happened. All right, some comments. We're at that 6,000 level now with the S&P. We have the NASDAQ, the mid caps, and even the small caps. They were the stronger area in Monday's session. People like what is being proposed as far as the economy, and that tends to be more favorable to small caps. And we have the Dow right around the 44,000 level, set new all-time highs. Now, the NASDAQ was down. Actually, I don't think the NASDAQ should be on here. The NASDAQ 100 did decline just a little bit there. We did see where mega caps and semiconductors underperformed in Monday's session. Just not really changing at this point, not really turning over to negative. In fact, our bullish percent index went up for the NASDAQ 100, just kind of taking a little bit of a breather at this point. And we're watching for FOMO, the fear of missing out. The first time I really saw this was in the late 1990s with the dot-com boom. And anybody and everybody that didn't seem to know much about the market was getting involved in the market. It was the cool thing to do. And that's when I went, okay, this party is just about over. But it lasted a little bit longer than I thought it would. But when it ended bad. And a lot of people that suddenly appeared to be stock market experts were like closing their brokerage accounts because they lost all their money. So I don't know if something like that's going to happen now, but you do have folks, because it's a free market system, you don't have to know what you're doing to invest in the stock market. And we're wondering if that is what's happening here because people are thinking, okay, well, if it's going up now, it's probably going to go up even more. So I better get in the market. And usually something like this can be more short to intermediate term in the impact, where back in the late 90s, it just switched the whole character of the market and we switched over from being positive to negative. Now, there is a difference this time in that the dot-com boom was fed by dreams and fantasy, and companies were worth billions of dollars that hadn't even made a dollar yet in any kind of earnings, let alone profits. Well, there seems to be earnings behind companies now, and so it's not quite the same. So to make an absolute comparison is not necessarily what I would do, but there are always some similarities to be aware of. And then Middle East escalation, oil's dropping down. We're getting into the 68 range now, and we still have a pretty long list here in the short term. The VIX is still going down pretty fast as measured by the RSI, the short-term RSI. We also have the rate of change going back 5 periods. These first two are usually ones we don't see all that often, and they tend to not stay on this list for very long. Now they've been on this list for a few days. But then we have the Stochc RSI, Williams percent R, CCI 14, 20, and stochastics. Those are the usual charts that we see when we're just moving and not necessarily extreme. It's showing more good, solid short-term momentum. The force index, usually that comes and goes, I should say, pretty quickly. It's still on the list. The boom indicator, we're still getting far away from that 20-period moving average. And then the short-term RSI, just based on the momentum of the S&P itself. All right, intermediate term, we still have the CMB composite. We're up into that +3 channel with the standard deviation chart, the Arun indicator, the Sean trend meter, the percent B. This is the third day now. I believe is it the third or fourth? We're still outside of the upper Bollinger Band. Now it's coming down, but it's still extreme, and we're getting kind of far away from the 50-period moving average. And a new addition here is the bullish percent index for the NASDAQ 100. Long term, still looking pretty good here with the 150 and 200-day moving averages, but you could consider that to be extreme. Another way to look at that is long-term momentum still remains really solid. Okay, no change to the scenario from the last time I did the video. The Fed did come in and cut rates last week, and it does appear that the soft landing scenario seems possible. Now, there's some folks that I listen to that actually respect that think that we may head into a recession, and that may happen. Well, we'll just keep an eye on things, but to forecast it one way or the other, that's not how I do things. I try to look at the evidence and then make a conclusion based on that. The dollar was up, and interest rates, they were unchanged because the bond market was closed. We're still inverted with the 10 to the 3-month and to the 10 to the 2-year. That's, of course, going back to last week now. Sentiment is getting more positive. We're not at that 75 level yet, but we are positive at 68. If we start bumping into the 70s here, that's when we'll be a little bit more concerned that maybe we've gone up a little too far too fast according to our short-term indicators, and that sentiment is getting a little extreme positive. We are positive with the trend. The green line's going up. It actually came down a little bit. And I'll show the chart here. We're getting a bit concerned that the green line is getting really high right now, up near that 40 level, but it came down a little bit. We are above the moving average, so the trend is strengthening. And with this even teeny tiny update, our bias is positive and our momentum is positive here. We didn't have any economic reports, and we're not really going to get much in the way of economic reports on Tuesday either. It's really later in the week, and they're going to be big ones when they come out. All right, Isabel Net here. The post-election jump has been sharp, but continues to be very strong. The very strong rally of the last 2 years. We set the lows way back here. It was really October of 2022 when we set the absolute low. And at that time, folks thought, man, I was getting messages and emails because I was like, okay, the market looks like it's possibly oversold here. It could be putting in a bottom or at some long-term support. And people were like, no, 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 we're just getting ready to go to the downside. Well, that was the bottom right there. And this is the trend channel that we see going up from the October 2022 lows. And we're still going up here. We're not even up to the upper band according to what they have placed on this chart. Okay, Americans are holding record shares of their assets and equities. Stocks over the historical norm have been a good place to be. And that's the light blue line here of folks that do have stocks. The valuations, and I go over this in the weekly intermarket analysis video, where this is the PE ratio here. We're well above 20 right now. But as I say in that video, I don't use it as a timing mechanism because look at how long we've been above 20. According to this chart, we've been up there. We had the downturn in the last spring, and then the crash day that lasted 2 days when the end of the world was happening in August. We've been above 20 all of 2024. So if you did things according to this, if we go above 20, it's like, I'm out of the market. You would have missed a huge advance during that time. And then the rotation from active to passive. Now, I always like to explain this. I go through this in my course that a passive ETF is like the SPY, where we don't have to pick what stocks are in the SPY. Standard & Poor's does that. We don't have to pick the stocks that are in the Dow. The Wall Street Journal board does that. Those are called passive because we're not picking and choosing what stocks are actually in the ETF. And that same thing applies to mutual funds. When we're in a solid uptrend, that's when passive funds tend to do the best. That's when the indexes tend to outperform the alternative to that, which are active ETFs and mutual funds, where you've got some rock and roll manager in there picking this and selling that, buying more of this, and trying to come up with all their strategies. That when we're in a solid uptrend, that the active approach to investing actually underperforms quite a bit. Where the passive approach, just get into an index fund and ride that out. Now, where this flip-flops, where we see the active asset managers actually doing better, is when we like 2022. Now, it doesn't really show that here on this chart, but I have other charts that show this. And this is just showing cumulative flows of money going into those areas, not the performance of those areas. But when we hit difficult times like 2022, the market was in a what I call a cyclical bear market because the longer term bull market was still intact. That's when these funds tend to perform better because there's more maneuvering. Where if you're in an index fund at that time, you just ride the thing out and you just kind of, okay, well, you chalk it up and you rationalize it as dollar cost averaging. We're going down and I'm still adding my money every month. Well, as we're going down, I'm just buying more of that ETF or that mutual fund. But this just kind of shows how the money has been flowing in here. And then I actually talk through the performance of active versus passive in the course that I teach. All right, then looking at volatility premiums, they're actually really coming down now since the election. With bonds, we're seeing the move index that measures the volatility of bonds. That's coming down. The VIX has been coming down, and we're even seeing foreign exchange volatility really dropping down. There was a lot of fear built into things before the election actually happened. And then presidential term, and you can stop this and look at it over here, where when Trump was president the first time, This is the performance of the S&P, and it's red not because it's down, but because it's Republican. And then how things have performed thus far when Biden has been president. And everybody, oh, we want a Republican, we want a Democrat. Well, we had a Republican back in the 70s, and if you grew up at that time like I did, that was not a very good time. And we had our president actually have to resign at that time. And then this was the first Iraq war with George W. Bush. And then you had, George H.W. Bush. And then his son came in. Well, that's when the dot-com boom ended up falling apart. And then we had 9/11 and we had Afghanistan and the Iraq war, blah, blah, blah. And that really has an impact on things. So and I keep trying to say this, the markets don't care if it's Democrat or Republican. They do tend to care that there's a split in Congress, and it looks like that's not going to happen. But at least to this point, they kind of like that because they're talking all kinds of changes and reforms that the market seems to at least like to this point. I mean, they'll find reasons not to like things, and if you say something and then it doesn't get done, that could, of course, could turn things more negative. All right, then looking here at the risk on. These are like small caps, IWM. That's the small cap ETF. The financial sector, which has done great in 2024, and high yield bonds here. Those are junk bonds. You can see money's just really going into that right now. Folks are willing to assume more risk. All right. And then this chart actually was not on Twitter. It was actually a screenshot of an interview that I was watching. And again, this is how you can take data and change it to whatever scenario you want it to be. Where there's been a lot of talk about the trade war tariffs. Okay, now Trump set those up, yeah, and he's still talking about doing those, but it was Biden who actually, it's not like he came in and stop those. He actually collected a lot of money from those tariffs. This is just the political gamemanship that goes on where, you say thing, you take some bit of data and you switch it all around to make me look good and make you look bad. That's what politics is about. That's why I prefer the theory of political science rather than the art, because it's just crazy. All right. Then Yardeni, he's talking about China in his latest post right now, so I didn't really want to include any charts there. Kind of a sleepy day compared to what we've seen lately. We opened up pretty much at the high for R1, and we were able to chop along that. We drifted, we got down, went negative a little bit, dropped down below the daily pivot, but then came back up and just kind of sleepily went into the close. Not much of a change right now in the intraday chart in the initial overnight session. And we did see a little bit of an improvement here. Europe had a good day, and that's really where some of the strength, at least initially, came from. And we didn't give too much of that back. We ended up being little changed on the day, but at least that led to a more positive open. And we're still looking pretty good here with the blue line above the red line when we look at large cap growth versus value on the intraday chart. Still, we had that big move up and then a move down here. But to take a bigger picture, if you go back to Halloween, the growth to value ratio in the S&P has been improving, and we'll be seeing if that can continue. End of day, growth was actually down where value was up, and it was up less for the mid caps and up strong with the small caps, but still up less than value. So we're seeing a bit of an improvement here with our small cap growth to value ratio, but still in a longer term downtrend. The same thing with the mid caps, improving, but in a downtrend and kind of chopping sideways right now, but still in an uptrend while we look at large cap growth to large cap value. And still above the rainbow, tick down just a little bit when we look at the growth versus value ratio here. Discretionary, and this has really been coming on solid here. And we're seeing some strength in discretionary itself, some weakness here in staples. That's what's helping the ratio really going up. And that's more growth oriented. And you have Tesla and Amazon that are included in that sector. And if those two companies are doing good, then this ratio does well. And things like ARC suddenly show an improvement. Large cap growth just setting another new all-time high. And the trend, see where we came down a little bit with the green line? So we're still getting a very high reading here. But when we evaluate the trend, we are trending because we're above the moving average and both lines are going up. The green line is on top. The red line is still declining here. So this is still looking more positive. And we're almost got up to that 40 level here in the short term. We are trending in the short as well as now intermediate term trend or environment or time frame. We did drop off with volume, but we were still above average. And then sentiment. This is that weekly chart where we take a lot of different sentiment gauges and cram them together. It's dropping down, but we're still coming in at 74.07 here, just on the border of getting into extreme positive. And then this is another chart that shows the legal insider transactions ratio, where it's starting to come up. Folks have been doing some buying here, and that could end up being more bearish. And we're seeing, with everything else going up, we're seeing this ETF that focuses on insider buying also showing some improvement. And the VIX is continuing to fall. We're under that 15 range, both with the line chart and the bar chart. The VIX of the VIX actually ticked back up just a little bit here. And we're getting kind of a low reading now with the VIX RSI, meaning that we've gone down a little too far too fast. We're really dropping with the VIX here, and that's when we get a low reading, which means stocks have been going up. And we're still kind of in the lower end of this red area with the skew index. The market's still thinking, something big is still yet to happen. And the momentum of the VIX continues to be down, and we compare that with the historical chart, doesn't really match up all that well here. But if we do slip over into positive seasonality in November, December, and going forward up until about April, we would generally see the VIX continue to decline here because stocks would be doing well. And we declined with this fear gauge, but it's not really realistic because the bond market was closed. And this one also, bonds, it dropped off, but the bond market was closed as well here. We're dropping again with the equity put call ratio on the daily chart, and we're starting to get extreme now with the 5-day chart. And when you look at this longer term, when we get down below this green line, now we could still go lower than where we're at now, but sometimes that can mark a shift in the overall market climate. And we're also continuing to decline with the 10-day equity put call ratio, really dropping down now with the volatility risk premium as the market has been going up. Still looking good here with the advanced decline line based on price, but we have not exceeded the previous high, but we have exceeded the high based on volume. And over the weekend, I was trying to point that out that this could be volume leading price higher, which could be positive. It's not a given, but it is something that we look for and can often be positive. And still, just seeing a real breakout of the new highs. I don't know what's going on with this 5-day. It's like, okay, I'm just going to be stubborn and go down. While clearly this is positive when you look at it by itself, the 10-day seems to be a little bit more sane here by it actually going up. And we're above the moving average now. We came down a little bit, but accumulation distribution is still looking solid. We're above the midpoint with the short and intermediate term advanced decline ratio. This is the concern that I'm seeing right now, the chicken money flow. We had an all-time high on Friday, another all-time high on Monday, and this is continuing to drop off, and the red line's starting to come down. But this is one of the few negative things that we're seeing, but it's an important negative thing. Now, Tuesday could come in, we have a solid up day, this could turn and go up, but at the same time, we don't know what's going to happen. Right now, this is like warning, warning, not that things are going to change, just something that we're keeping an eye on. But we're still going up with the chicken oscillator. That's clearly positive. And the vortex is positive as well. Not really seeing much of a disconnect between the S&P and the NYSE advanced decline line. And again, here we're seeing volume setting a new high with the cumulative measure with the S&P, not quite setting a high yet when we look at this based on price. We are setting all-time highs with the cumulative advanced decline line on the NYSE, but we have not set a new high with the NYSE advanced decline line. But we're still positive. I mean, we're going up even with this other advanced decline line here. And when we break it out based on price, not a new high, we are setting a new high based on volume, which could be positive. The advanced decline line still looking pretty solid across the board, and we're seeing some kind of renewed strength here in small caps. Is that going to be able to continue? And just setting an all-time high here on the daily chart. The takeaway I have is that we're still slightly above the moving average when looking at volume. And just showing that things are positive here with the 20, 50, and 200-day moving average study of the S&P. We're still extreme with the rate of change going back 5 periods. And you count the number of bars and you go, well, this is where we were at, and this is where we're at now. That's why this is freaking out. Now, let's see, 1, 2, 3, 4. Now, this is probably really going to drop unless we have a monster up day again, because the gap from this was the day before the election and the day after the election, that's going to drop off the 5-day calculation. And so this is probably going to come down. Stochc RSI just showing either overextended to the upside or good short-term momentum, as well as the Williams percent R, CCI 14 and 20. Stochastics looking extreme in the short, intermediate, and improving, but not extreme in the long term. And I like to say this for people that are new. This is a further subdivision of the short-term time frame. Still extreme with the force index, well above the Keltner band here. The condition of the short-term moving average is measured by a double and triple exponential moving average. Above price, the lines are going up. Short-term trend looking solid. We're above both the simple and exponential moving averages. With the exponential, the blue line starting to cross above the red line, that's showing more momentum to the upside. We're in the +3 channel with our standard deviations chart, but we can stay there for a while in a good solid environment. It actually came down here. We're back to 0 with the balance of power, but so that's kind of neutral at this time. Still looking extreme with the CMB composite. The condition of the 50-period moving average, which is intermediate term, we're seeing the red line crossing back above the blue line. That means the intermediate term trend is still looking pretty solid there. Positive with the no-go system. And coming up with the blue line going up here with the highest high value. TTM squeeze. It didn't really participate in the party going on back in October, but it's starting to show a little bit of happiness here. So it's looking more positive. And standard deviation, which measures speed, either up or down. It's still getting a very high reading until we get beyond this look back period of 10 days. And we're positive with the ease of movement. We're back to extreme positive with the Erin indicator. The oscillator is pegged pretty much as far as it can go to the top. Above 0 and going up with the S&P McClellan oscillator. So we're going back up with the summation index based on price and volume. Back above 0 with the NYSE McClellan oscillator. So we're going up with the summation index for the NYSE based on price and volume as well. Momentum is now shifting and looking more positive here with the PMO, also based on price. Not quite not quite crossing positive yet based on volume, but still looking pretty solid with the PMOs that are rising. The buy signals are going up and leveling off, but still tending to go up with the PMOs that are above 0. Swenlin trading oscillator above 0 based on price and volume. That's positive. Turning back to positive in the short term with the slope oscillator. The MACD is also positive. So in the short and intermediate term, we're positive. Now the tricks in KST, which are longer term, they take longer to move. They are improving, but they haven't quite crossed their moving averages yet. The Copic curve is now positive and remaining positive. The Sean trend meter giving us an extreme positive reading. Money flow above 50 and positive. Ultimate oscillator positive. On balance volume positive. The percent B coming down, but still slightly outside of the upper Bollinger Band. Above all the plotted moving averages here. So trending, we're looking really solid. And positive with the Elder's Impulse system for the S&P. Positive with the parabolic SAR. We're back to going up with the bullish percent index. That's positive. Going back up slightly with the NYSE bullish percent index and starting to get extreme with the NASDAQ 100 bullish percent index, but it could still go higher than where we're at now. And really nothing as far as support or resistance right now because we seem to be just moving to the upside. So on a trending basis, the Heiken Ashi is positive, the Kegi is positive, the Renko is positive, and the 3-line break is positive. Long term, still well above the 150 and 200-day moving average lines here. Now, sometimes we count this as being extreme, but as you can see earlier in the year, we could get well above this. Positive across the board with the Keller market model on all time frames with all indexes. Negative, well, we didn't really change with bonds because they were closed. We're negative across the board with commodities right now, where the dollar is in a short and intermediate term uptrend. And we saw discretionary actually performing about the best. Financials, that's been a stronger area. Communication was up. We saw staples down. That's more defensive. Tech didn't really have a great day, but it didn't really fall apart. And real estate probably still wants interest rates to go down. An awful lot of green or blue here. We have the S&P setting an all-time high, Nasdaq setting an all-time high, Dow setting an all-time high, got above 6,000, and then the Nasdaq and Dow crossing above things, the dollar going back above 105. Staples had a bullish MACD crossover. Now that's more defensive, so we'll keep an eye on that. Energy also having a BPI where it dropped below 50. Now it's going back above 50. Where we have healthcare dropping below 50. Dow setting a 4-year high. Nasdaq saw a little bit of weakness, and then the S&P ended up setting a 4-year high, as did the Nasdaq. Positive across the board with the decision point scorecard here. No real disconnect between the S&P and equal weighted version of the S&P. They're pretty much moving in lockstep with each other right now. Dow setting an all-time high and looking positive with the diamonds. Nasdaq setting an all-time high. Nasdaq 100 was down just a little bit here. Let's see, the Nasdaq. Yeah, the Nasdaq was up, so it did set a new all-time high, where the Nasdaq 100 was down slightly. But we're still positive with the Elder's Impulse system for the Qs. The momentum for the Nasdaq 100 is positive. Small caps, okay, are they going to be able to keep going? They were the strongest area in Monday's session. Positive with the Elder's Impulse system. And looking a little toppy here with the Russell 2000 small caps with the RSI above 70, but good solid momentum as we're seeing by the MACD here on the bottom. Mid caps setting another new all-time high. Positive with the Elder's Impulse system. Setting a new all-time high with the S&P, that's being confirmed by the all-time high in the Nasdaq. Breaking it out, the equal weight is setting an all-time high, and the equal weight version of the QQQs also setting an all-time high, even though it was down just a little bit. It's really hard to tell here. I don't have the changing value, but the Nasdaq 100 was down. The equal weight version looks like it was up slightly. Transport's doing good, chopping sideways for most of 2024, going back and setting another new all-time high that was previously set in 2021. The Wilshire setting an all-time high, total U.S. stock ETF setting an all-time high. Keeping an eye on this, we're seeing kind of a disconnect between the S&P and the Home Builders ETF. You can see the correlation is really going down. If we cross below the midpoint and keep going down, that might be a bit of a concern. So we're just watching this for right now. Financial sector, back to setting an all-time high. The FANG index, not an all-time high, but still looking solid. We might be hitting some overhead resistance with this shorter-term trend line. We've not been able to get above that at least yet. And then here's traditional Dow theory with the Dow setting an all-time high. Transport's coming back setting an all-time high. That's positive, and that's a Dow theory confirmation. We are seeing a little bit of an improvement with the utilities, but not the strength that we had been seeing earlier on in the year. Apple was down 1.2% below its 50-day moving average. Amazon was down 0.64%, but still coming off of an all-time high. Microsoft still flirting around here. It was down 1%. But it still has not generated a death cross at least yet. That's probably going to be a big deal. A lot of people own Microsoft. A lot of people use a moving average crossover system to make their determination. If we do see a death cross here, that may have some influence. Google was up over 1%, and Meta was down over 1%, but still above its 50-day moving average. Nvidia down 1.61%. Now look at this, Tesla. They just really like what's going on here. Now some of this is probably carryover for the impact that Elon Musk had for the election, but at least Tesla's stock is benefiting from that, which is probably why ARK is doing better, the ARK ETF. Netflix setting another new all-time high. I actually watched a couple of movies over the weekend and they were pretty good, so I can see why their stock's going up. That's supposed to be funny. All right, oil still not really breaking to the upside due to geopolitical reasons. The dollar is still looking pretty solid. It's still traded. The longer we stay above both of these lines, the more we might actually see a golden cross with the trend. I don't cover bonds because they were closed. Still looking okay here with the Q to S&P. What's really improving is the discretionary to S&P and large cap growth. It came down just a little bit compared to large cap value, but still above the moving average. So the large caps, mid caps, and small caps really seeing across the board improvement, especially with the mid caps and small caps right now. Not much of a change here. We're still wondering, the overall context has been the S&P to utilities ratio has been going down. Are we going to be able to switch and go back up, which would be more positive for the S&P? And we ticked up just a little bit with the staples to S&P. Is the context going to continue to go down, which also would be positive for the S&P? All right, so we are positive right now as far as our technicals. We are in a period of positive seasonality, but it doesn't mean we're going to go up every day. We are possibly looking extreme in the short term, and we're possibly saying, okay, is the fear of missing out, is there more emotion than logic, which is driving the market higher right now? We're going to get the Treasury budget, which is not that big of a deal. So it's almost like another non-economic report day. Geopolitical events, just keeping an eye on those things that could change at any time. CPI is going to be coming out on Wednesday. PPI is going to be coming out on Thursday. We're going to get retail sales and industrial production as well as capacity utilization on Friday. Don't be surprised if things calm down a little bit in Tuesday's session because it's ahead of three major economic reports. And here's what we have looking going forward for the rest of the week after Tuesday. Seasonality, we're neutral to negative with the Dow, neutral to positive with the S&P, or we're just flat out positive with the Nasdaq. So we'll see if we can set another new all-time high. Now we are coming into the week after, or excuse me, the week of options expiration. And we tend to be up 58% of the time and down 42% of the time over the last 73 years. And Tuesday is a coin toss as far as based on what happened in 2023, whether it's going to be an up day or down day. This has been updated now, where Tuesday is up, but it's the least positive day so far in 2024. And then we're still kind of in that time now where we're coming out of the negative seasonality and more into the positive seasonality, according to Tom Bowley's research. And we're seeing less of an impact here on the buyout blackout, the buyback blackout. Try to say that fast three times. It's still on here, and I'll keep showing this chart until we run to the very end, but it's not as big as it was while we were going through the month of October. Seeing positive seasonality here according to the Carson composite cycle. And this is after the election, which tends to be positive. This chart also shows how things reacted in 2020, which were positive. So the warning signs, this is it for the negative side right now. A confirmed Hindenburg omen that's just kind of lingering back there. That's it for the negative side of things. And we have a pretty positive list. The one thing that is a concern is the chicken money flow. It's not showing strength. In fact, it declined a little bit. So we're going to be watching this. Is that giving us a warning sign? Right now, it's just something, it's like you're not running out of gas, but you're getting down to about a quarter of a tank or so. Just something to keep an eye on there, where the other two smart money indicators are still positive. The vortex is positive. We're looking pretty good with the large cap growth to value ratio, as well as discretionary to staples, which is really improving. The 5 and 10-day equity put call charts are going down, with the 5-day now looking extreme. Advanced decline line's looking good. Now, there was some really weird data coming out here, so I didn't show the moving average studies here. We'll have to see if they changed some symbols with stockcharts.com or what, but a lot of those charts were really pretty funky looking, so I didn't show those. The parabolic SAR is positive. The Swenlin trading oscillator looking good here and positive with the S&P and NYSE McClellan oscillators as well as summation indexes. And the bullish percent indexes for the S&P NASDAQ 100, which is now extreme, and the NYSE bullish percent index. Momentum oscillators turning back to positive, except for the very long-term ones, but they're improving. Ease of movement, money flow, ultimate oscillator are positive. The financial sector setting an all-time high, and the momentum for the NASDAQ 100. Our conclusion, we're positive. And we're coming into a time of positive seasonality, but are we a little overextended in the short term? And are people just throwing money to the market for fear of missing out? In the short term, we're possibly looking extreme or overbought at this point, as well as in the intermediate term. We're also, you could make a case that we're overbought in the long term, but we're still looking positive there. Thank you. I hope this was helpful to you, and I hope you have a great day, and I will talk to you in the next video.